Hi guys, welcome back. My name is SHANTANU. Once again, welcome you all to the fast track batch in English for the subject called as CIRV, Corporate Restructuring, Insolvency, Liquidation, and Winding Up. So now we have already completed various chapters for this subject, and now it's the time to start another chapter, like a new chapter, which is called as Process of Mergers and Acquisition Transactions. So when we talk about mergers and acquisition, that's the ultimate goal that we will achieve, right? But there will be so many other things that we have to qualify before we reach to that particular stage, right? Before we receive this merger or the acquisition as a result, there's a whole lot of process, whole lot of stages that needs to be passed, whole lot of hurdles really that we have to pass, and then only we'll get the desired result. So we'll talk all of that one by one. But first, let's try and analyze once again mergers and acquisition. I know that we have done this a lot of times now. Like all the previous chapters did talked about the mergers or amalgamation acquisition to some extent. So maybe we'll just again try and just recapitalize those things. So here it's being written: merger is generally being done to make the company, as you know, more stronger, more efficient. And once the management think of doing any of these restructuring, they should, which I think they will, consider about the taxation, which can not just be income tax but about the stamp duty implications as well. Because if the mergers is being happening and the assets etc getting transferred, there will be implication of stamp duty as well that will be attracted. So that is another thing that has to be considered. In regarding the prerequisites of mergers and acquisition, the first is the due diligence. I mean, you cannot just buy anything and everything. I mean, there could be like you will be having a lot of money, but still you will not like to waste it, right? You will like to even develop and probably gain the money, or probably make sure that this money actually get increased and invest in the right direction, right? So I think the first and the foremost stage is doing the due diligence as to which company you should buy or you should enter into the transaction with. Because they are like, I mean, they are, let's say if I talk it in a very general or a layman perspective, uh, there are people whom you like but they don't like you, so or vice versa as the case may be. So it is not like about the likings, right? We are here for a long term association, we are here to do a particular purpose, so that particular purpose has to be achieved. It's not like that you like the company, you just like something about the company, so you went on and buy the same. You also have to understand whether or not in the future will this be a viable decision or not. So I think all of that has to be considered. Regarding the business valuation, the ultimate objective of doing all of this is to earn more and more money, gain goodwill, gain market share. So I think if that is being satisfied or not is something that have to be discussed. Then talking about the strategy, because maybe the company, the acquirer, is a very strategic company. You know, they take all the decision based on the strategy, policy, and process. While the other company they've been thinking to acquire is not that much organized or that much planned, which is not bad anyway. There are chances of improvement. Like everybody is not perfect, and I get that. But it is like you have to be sure enough that you will have to spend a lot of time to streamline the process. So I think that's what we call it as an integration, because the things have to be interrelated to each other. The things really have to click, and thereafter only the things will move ahead. Now, talking about who can really oppose any scheme, so we discussed earlier the any shareholder holding 10% or any creditor who has an outstanding debt of 5% can object to the scheme, and they have the powers to object provided they have some reasonable grounds. When it comes to the amalgamation or merger of Indian and the foreign company, RBI gets involved. The voting in this entire process will be done by the shareholders, and it can also be done by e-voting. So that's what has been written here. In regard to the due diligence, which is another steps when we actually talk about restructuring, due diligence is one of the step, and due diligence really help us to identify some of the major points. Like you, if any person you meet with any person, let's say 4 times, 5 times, I'll talk about arranged marriage, right? So if it is a love marriage, more than likely you will know each other. But if it is an arranged marriage, then you may meet that particular person 2 times, 3 times, 5 times, 10 times, or let's say even more than that. but it will still be a thing whereby you will not know completely about the other side, right? You will now have a better idea. Probably when you met first, you didn't really have any idea. It was just about imagination. But now you have met so many times, so you have an idea. But still, you cannot guarantee, right? So that's why due diligence is really required. And the more we do the due diligence, we're able to find out the things more. But I think there has to be a limit, because uh, otherwise this will just be an investigation and nothing will come up. And I can tell you one more thing, that nobody will be up to 100% your expectation. They can be 80%, 70%, even 60%. And probably for you, I mean, if I consider the other person perspective, because the other company who is getting merged into your company, or the other company that you've been trying to acquire, they may also not go with just any company. So they will also consider you as the viable partner or not. So that's what due diligence really all about. You try to analyze ins and outs of the company to find out more about it, so that you can decide whether or not you should move ahead, or probably enter into any kind of transaction. Because this is not something that you can reverse. There is no undo button as we have in computers. It does not have a undo button. Once this transaction start going, there are so many expenses, so many documentation, so many approvals needs to be taken, compliance need to be fulfilled. So you have to first be very clear that what you've been doing. If the company is a loss making company that you've been acquiring, it's perfectly fine. There's nothing wrong. If you think that's the best option, that's perfectly okay. But the most important part is that you should be aware that what you've been doing, and the kind of the efforts that will be required to make this right. If you're ready for all of that, I think that's the answer. And this is the only and the wholesome object as to why due diligence is really required. Because sometimes the things really look, you must have heard that the grass is greener on the other side. So the company look pretty interesting, everything is good about the company, nobody says bad about the company. But then when you acquire the company, you find out so many loopholes in the company, that you thought that every information that you got about the company was fairly incorrect or was incomplete. In terms of the due diligence, it could be divided in operational due diligence, meaning the way the company may operate, like in terms of the strategy, policy, and process. Then we have strategic due diligence, which talks about strategy as to what needs to be done, what needs not to be done, when it needs to be done. So there's a calculated planning behind every move that will happen. Then we have technical due diligence, which includes probably the use of the technology inside the company. Because a lot, I think in today's time, technology is really one of the important factor, and can really help us to do a lot of things in a short span of time. I mean, why we will go somewhere else? Let's take the example of you and Shantanu and Tanya Academy. You sitting in just any corner of the world. The reason I say world, because we do have various students who've been taking the classes from Dubai and various other places across the world. So you being sitting in a different time zone, in a different state, and in a different country, and I'm obviously in a different state, different country, but still we've been connected to each other, right? So that's how technique actually works. So I think that's what we also have to consider when we actually move ahead. Then talking about the legal due diligence, we'll try and find out that the company that we've been trying to acquire is okay or not. Because sometimes there will be so many legal cases on the company, and there could be so many legal outstanding liabilities of the company, that it becomes really difficult to repay all of that. So we have to be prepared that yes, if the company has any kind of liability, what kind of liability they are, what is the amount due, etc. In terms of the financial due diligence, we also have to find out the finance of the profit and loss side of the things. Also, it talks about the fact whether the company has a reserve, the surplus cash flows, all of that. So I think that is also something that have to be considered. In regard to the practical guide to due diligence, I think it is something that you will get to know when you do it, right? Uh, if somebody comes to you, or if you go to somebody, like vice versa, and you being assigned a task to actually find out about that particular guy or a girl, right? What you will do, you will ask questions, you will probably judge them by the way they answers, their acts, their body language, the confidence level, so on and so forth, right? You will keep on doing all of that. But even after doing all of that, there could be no guarantee at all that this is the logical conclusion. Because if another person actually judged the person that you have already judged, he may or she may have a different conclusion altogether. So due diligence does not have any specific or strict criteria. It just depends on what factors do you want to, have more due diligence, and what are those which can be taken lightly. But due diligence is more of the fact where you've been trying to know the other side the best you can, so that you can take the decision which could be in the interest of both the parties. Due diligence can be done in various areas, like about the environmental aspects, cultural, legal, IP, litigation, marketing. All of that is a part of the due diligence, but obviously we will have to find out which are the main ones and which are the ones that will be considered at the last. I'm not saying that any of the areas is not important. Everything is important in the company, because that's how it make it as a good company, as a good brand. Uh, but we'll have to prioritize it and then deal accordingly. Then we have the due diligence process, which has been divided in various categories. So now taking this further and discussing about the due diligence perspective. So I think, as we were discussing, due diligence is primarily an exercise whereby before entering into any of the formal agreements, you try to verify the exact or near to exact position. So when we talk about due diligence, we'll try and analyze the company from different perspectives, starting with the industry analysis, talking about the rate of the competition, and if you pay a lot of amount to acquire the company, as in goodwill, brand name, is it worth doing that or not? Then what about the HR policy, the management strategies, and how the management has been running this company for the past years? That will also be considered. Apart from that, is there any serious or non-serious compliances incident whereby the company is in compliance to the labor laws practices as applicable? And then the reason why you've been acquiring this has to do with the financial side of things. So we'll definitely consider the existing scenario, the existing financial position of the company, what kind of cash burn the company is being doing at this stage, or is it a loss making venture, or is it at break even, or probably a profit making entity. Whatever the scenario will be decided by finding out the financial ratio, which can be like the most simple and the most common is the solvency ratio. So the ratio gives you an idea as to what should be the position. So for example, solvency ratio should ideally be always 3 is to 1, meaning the asset should always be double and the liability should be half. But now if the entity has 1 is to 1, meaning the assets and the liability are equal to each other. So this is something that you should consider. But then if it is just, so the financial ratio is really very important and has to be considered, especially if it's this much serious. Because as I was saying, that once you acquire the company, you shouldn't be left with surprises. As I'm sure every one of us really likes surprises, provided they are positive. So that's what financial ratio do for us. In terms of the due diligence on the IPR side of things, we should know, being the acquirer, what kind of IPR are being held by the company, whether they are probably using their own IPR or hasn't been assigned to them by somebody, and if the case, then what is the amount of royalty that is being paid by the company to the owner of that intellectual property, and if the company already has its own IPR and they have given it to somebody else, what kind of royalty the company is being receiving, what kind of tenure is being remaining for those IPR. Because as you know, when it comes to technology, I mean, patent is valid for a period of 20 years since the time it is being granted, right? So when we talk about this, it actually give us the opinion, meaning that if the technology is already 15 years old, then I mean, it's just like 5 years are being left. But having said that, you have to understand that technology keeps on updating every minute, not just every day or anything like that, but every minute things getting changed. You buy a new iPhone, whatever number it is, 14 or whatever, then you realize within few months you'll get another iPhone, and probably which have something more. So the technology keeps on updating, right? So we have to analyze and thereafter actually move ahead with this due diligence. In regard to the compliance status, whether the company has filed all the annual filing and the necessary statutory records with the statutory agencies as applicable to the company. Because if it is a company, then the Companies Act 2013 will definitely be applicable. But let's say if it is a company that has to do with telecom, then the TRI also gets applicable. If it is a company that has to do with insurance, then IRDA gets applicable. So the sector regulator compliance also need to be checked. I mean, the whole point is to know what exactly due diligence is. Just a step which will help you to analyze a deal better. I mean, by due diligence, you will be in the position to know whether the price that are being quoted for the deal, whether that's worth paying or not, or can you actually dilute that certain amount, or whether or not you should really go ahead with that or not. So I think all of these factors really need to be considered. In regard to the due diligence report, it says that the due diligence report, whenever will be prepared, I think it will have the following points. These are some of the basic points. It's not a complete list because it will vary depending upon the situation and the circumstances, but technically speaking, it will have the outlook of the management, the financial capacities as we discussed, the compliance status of the company, any of the legal or the compliance side of issue that the company is already facing, like any litigation that has been pending for years, and if the company actually lose the case, the company will have to pay a certain amount of compensation, and at this particular point of time, this is a contingent liability. Company is not really sure what will happen, but in case the case goes against the company, like the case is not decided in favor of the company, let's say the company will be entitled to pay an amount of 50 crore rupees. So that is also something worth considering, because if you buy the company and then later on you realize that this is also a liability, the company lost the case, so you will have to pay, as a new buyer you will have to pay that 50 crore rupees or whatever amount. So you should make a provision for that, or at least you should be well prepared enough that this could be one of the liability that the company has to pay in the near future. In regard to the due diligence checklist, I think the buyer and the seller will also do their own due diligence. So it's not just I think the buyer that will do the due diligence, but the sell side also will try and do the due diligence, because if the seller has quoted, let's say, the amount as 100 crores for that company that they're being selling. So if after due diligence whatever has been said is being found, but till that time the competitors, this company, let's say this company is called as A Limited, its competitors are being selling the business which is worth less than this for, let's say, 150 crores. So this company will automatically also increase the price, So it's not just the buyer who will do the due diligence, the seller will also determine whether or not the price I've quoted is fair, or they should increase the price and get more money. I think that this is the same way, as to what we normally see in our day-to-day life. The seller wanted to sell a product so that he can get the maximum profits, right, at that price on which he get the maximum profit. While the buyer wanted to buy a product at the least price possible. So that's what the same thing is being happening here only. Both the parties are being trying to do the best so that they can protect their sides. In regard to the financial due diligence, it says that due diligence may help in carrying out the process and the financial side, as we discussed above. Because if the company who is getting acquired or who is being getting sold is in a profitable position, or whatever information has been given by the company is true and fair, and even after doing all the due diligence, it is being found that whatever has been said on records by the company means the company that is being getting sold is true, fair and correct. Because when the other party do the due diligence, let's say there's a company called as A, and this company wanted to sell itself, so the management has given every information. Now there's a party called as B who said that he or that B company wanted to buy this A company, but they will do the due diligence first. So A company agreed that yes, you are more than welcome to do the due diligence. So this B company did due diligence on A on all these points and found that whatever A has written is true, fair and correct. So that means the possibility of negotiation now becomes less, because A has already, I think, committed or said whatever they have said, that is true, fair and correct. So you cannot really put much pressurization on A to reduce the price. There could be negotiation, but now since A is not at fault, A has given every information true and fair and correct. So A will also say, like every other information, since they have given every information which is true, fair and correct. Similarly, A has also quoted this correct price only, right? So I think all of this will have a bearing on the final amount that will be paid in the deal. The better the records are being maintained, the organized the records are being maintained, I think the company will fetch a better price. Now the creditor aspects will also need to be checked, like who are the suppliers, on what payment terms, or what days the payment needs to be paid, whether there is any credit, and if yes, then how many days credit are being given by the creditors to the company. All of that need to be checked. If there's any existing dispute between the company and the creditor, I think we will just analyze anything and everything from a business perspective, because when we being acquiring a company, we are acquiring to make sure that we take this company forward, right? So any any issues that may come up in general day-to-day functioning of the company, I think the best due diligence will be the one that will consider anything and everything that's being related to that. Now, factors affecting valuation. So, the things that need to be kept in mind for the valuation perspective, it's like the company, if the company is a listed company, so the dividend, whether the company has paid or not. Then, what about the IPO or FPO? If the company is planning to launch any IPO or FPO, then definitely the valuation will be different as compared to the one where the company has no plans for the same. Then, liquidity, and then when it comes to the other factors, so those that we discussed just now were the main factors, but there are some secondary factors as well that have to be considered. Apart from that, we do have the methods of valuation, meaning that when we say that this company is worth 100 crores or 50 crores or 500 crores or whatever, we would have used some kind of a method to calculate the value. I mean, it won't be just like anything, right? We won't just say any number. It has to back with some logic, because I think if you say that this costs this much, anybody will try and analyze the logic or the reason behind the same. And when we've been doing this much and we've been dealing on a commercial or a professional front, we have to be logical so that it really help us to make the deal, or probably will help us to grow further. So in terms of the valuation, how do we determine the valuation? The first step is the relative method. Relative method is just like, for example, my business, which is called as A Limited, let's say this company, let's say I'm the director of this company. So this company has been running for past 10 years, and now I have a competitor called as B Limited. This company has also been running for past 10 years. And this company and my company, like B, the competitor company, and this my company A Limited, almost have same kind of revenues, same kind of a profit, almost the same, not exactly the same, but almost the same. And B has sold his company recently for 100 crores. So accordingly, I will also say that the competitor has sold a business which is kind of like me, like 90% like me, for 100 crores. So I will now do the valuation keeping in mind a benchmark of 100 crores, because if I'm better than B, then probably I'll make the business valuation as 110 crores or even more than that, because I'll take 100 crore as a benchmark, because B sales were pretty much less than A. A is still better as compared to B. So if B is getting a price of 100 crores, the relative method says that I should get more when my competitor who is doing less gets this much price, so I should get it more. So this is the concept, or this is the theory behind the relative method, which may not be very useful in this practical world. Then the super profit method is a method whereby the value will be ascertained on the basis or on the assumption that the company is a going concern. Meaning that if now the profitability of the company is, let's say, for probably 100 crores, the company has a profit of 100 crores. So assuming that if the sales, the expenses, the cost, etc., goes by, let's say, 10% every year, the cost gets increased, employee salary get increased, expenses get increased, but then the price also get increased, the profit value get increased. So after 5 years, our company will be worth this much and this much. So super profit method actually works on the basis of future calculation. It will take the stats, it will take the data as of today, but then try and find out what will be the value of the company if these things remains constant, because in economics we have to assume things. Unless and until you assume something, you cannot be anywhere or reach anywhere in economics, right? So you have to make an assumption somewhere. So super profit method actually talks about that only, that this is the profit at this stage, and if the company keeps on going this way as the way it is being going, we should at least expect this much amount of profit or this much valuation. So this is the super profit method. The other is the accounting professional methods. This is the method which is being used, or which are being based on the basis of various ratios, as we discussed earlier. Some of the ratio, like what kind of dividend the company is being paying, or the earning per share, the NAV of any shares that have been issued by the company. So I think all of this method will really require more professional guidance and expertise. So this is one of the methods that can also be used to determine the correct valuation. Apart from that, we do have company registered valuers and valuation rules 2017 that have been made in place now. And this is really good for the industry, professional stakeholders and the government, because prior to these valuation rules, everybody was trying to put a value which was quite arbitrary. I mean, the buyer who wanted to sell his product was trying to put just any value which was really very high, while the seller was not being able to determine what will be the correct valuation, because there was no fixed formula, there was no fixed method as to how you should determine the value. But with the implementation of these kind of rules, it really gives much more information as to how the valuation should be calculated. And there are registered valuers which you can also be the one, like company secretary, chartered accountant, cost accountant. Merchant bankers can definitely enroll themselves to be the valuers if you have the interest on that particular side of things. So that is one thing that you can really do. Apart from that, when we talk about valuation, I think valuation is really needed, because when it comes to mergers, IPO, probably ESOP, buyback, I think we will have to determine the value. For example, you wanted to sell your business. I wanted to sell this coaching classes, although I don't want to, touch wood. But for example, I made a mind that now I'll be moving outside India, let's say for example. So I'll not be having that much time now to devote, because already, as you can see, I have really worked a lot in this entire venture. I told you previously saying that I've already taught all the detailed classes of CS Professional. I've also been teaching some subjects in Executive, but let's keep that apart. So in CS Professional, all the subjects one in detailed classes, then started again all the subjects and did fast track in Hindi, and then started again all the subjects and doing the fast track in English. I think we have already done most of the subject. Only MDCS, I suppose, is being pending. Rest all the subjects in English has again been done. So lot of efforts are being required, which I've already done. So I will take these into consideration, right? So I think, but this is the way that I think, but this is not the way technically market thinks. So I have to find a analogy. I have to find out any method which can be substantially used to find out the exact value, because they cannot be just one method, there will be numerous methods. So according to the market needs and requirement, I have to consider various factors, and then accordingly I have to judge. So in my case, I'll see that I have all subjects available. I'll see that all subjects are available in Hindi, then all subjects fast track is also available in Hindi, and then all subject fast track is also available in English. Side by side, I have so much experience, like 10 years being working as a company secretary in the company for past 10 years or more than 10 years. So all of that will be considered, and then final valuation will be determined or decided. So these are the factors that you as a business or an entrepreneur will definitely consider. Now, who can be the registered valuer? So I've already told those who are chartered accountant, company secretary, cost accountant can be the registered valuer, and even merchant banker can be the one. And the condition is that you need to have an experience of 5 years post qualification. So once you pass your company secretary examination, which I'm sure you'll do very soon now, you have to gain an experience of 5 years, and thereafter you can apply to be a registered valuer. You also have to give an examination for that, but at least you become eligible for it. Now the valuers can be divided as a financial valuer and the technical. So the one that I've been talking about, like CA, CS, CMA, and the merchant banker, is to do with the financial side of things. But if you are looking for a valuer who can just analyze the the things that have been the way the architect has been designed, the way the quality of the things are, then you require somebody who has expertise in that. So that for that purpose, the person has to be a member of the engineering institute or member of the architect institute, and thereafter they can be they can enroll themselves as the technical valuer. So depending upon what kind of valuer you want to be, you have to decide that. But in general, the qualification to be a valuer is that first you have to be that much years of experience. As I said, for CACS, like it is like 5 years. Then you have to pass the examination, and then you shouldn't be a minor, you shouldn't be bankrupt. So all of the normal conditions that are there as a competent to contract, I think all of that actually gets applicable to a registered valuer as well. Once you become the registered valuer, you have a lot of opportunities, like in terms of issuing further shares, or the company going into liquidation, or the minority shareholders wanted to do exit. So all of the valuation for these things will be determined by the registered valuer only. In regard to the qualification and experience, so the registered valuer probably depending upon, as we said above, depending upon what kind of valuer you want it to be, like the technical or the financial, the same qualification is being needed. and accordingly you will also have request of experience. And once you even do all of that, it is not a guarantee that you will be a valuer. You still have to pass the examination that are being conducted as per the rules, the valuation rules 2017, and then only you can enroll yourself or call yourself as a registered valuer. So that's how the entire process actually works. In regard to the further thing, which is code of conduct or conduct of valuation, the valuer has to be fair and need to disclose all the information in the report. Plus, the valuer should also check the background of the things that are being analyzed, and should also analyze and take into account the conflict of interest, if any, and accordingly prepare a valuation report and then gives its final conclusion. So that's what has been written in terms of the valuation. So taking this further, now we will start and discuss about the eligibility for registered valuer organization. So I think we discussed the qualification and the experience for a registered valuer, but now we're talking about an organization. So ICSI is also registered with IBBI, which is Insolvency Bankruptcy Board of India. So they have actually opened another kind of a not-for-profit company, which is like kind of a Section 25 company as per the 1956 Act, or Section 8 company as per the Companies Act 2013. So if you wanted to be an agency where if you want people to enroll with you and you give them the registered valuers qualification and the certificates, you have to get yourself enrolled with the IBBI, and apart from that you have to be an not-for-profit company. And also, when we talk about all of that, you will have to conduct the education qualification, and then the organization who is being trying to register themselves as a registered valuer should have necessary qualification, like should have necessary qualified staff who can really train the people, and should also have a disciplinary mechanism, so that in case anybody who has, let's say if somebody is a company secretary and he or she wanted to register themselves with a registered valuer, they can go and do a course like of registered valuers with ICSI. Like ICSI has an additional stream or an additional branch for valuation, so you can enroll yourself with them and then complete the entire course. And then in future, if there's any wrong that have been done by that particular registered valuer, so ICSI, this registered valuer, the branch of ICSI, should also have some grievance redressal mechanism as well. So all of that need to be considered before you really apply to be a registered valuer organization. Talking further, we talk about the SEBI ICDR Regulation 2018 and the amendments thereof. So it says the face value of the equity has to be mentioned in the offer document, because I think this is also one of the important factors. You wanted to buy shares of the company, but sometimes the shares are too costly, and some of us may think that it's not worth investing. So we really need to know what is the offer price of the company, and this will be mentioned everywhere, be it the offer document, on the application form, and all the advertisements. The other option around this is a price band. So one is the fixed amount issue, which is like the normal thing. The other is like a price band, or you can also call it as a book building process, whereby a minimum and a maximum range will be mentioned. The issuer will not be able to tell you the exact amount or exact price per share. So it's just like when you apply for the shares, you will bid at a particular price. For example, the issuer has mentioned saying that the price band is from 200 and 200, starting from 200 and then goes till 220. So if you think that the company shares are worth 210, so you can apply for that. But if I think that the shares of the company are worth even buying at 220, I will apply for a price of 220, and depending upon what majority says, the price will be determined. So this is also one of the options whereby the price band will be mentioned, and finally when the offer gets closed, depending upon what has been said by the investors, this will be like the final price will be decided, and whosoever has quoted that price or above that price will be given the shares, and whosoever has quoted below that price, they won't be getting any allotment. So it's just like this is the minimum price, and this is the floor price. At this case is like 210. So obviously anybody who's been applying the shares and asking for the shares at rupees 205, they won't be getting any shares, because this is the minimum amount on which the shares are supposed to be offered. and this is the price band. So let's say even in this price band, the final amount or the final price was determined as 214, while I said that I will buy the shares at 210. So obviously I will not be getting the shares because there are many people who have actually applied for the shares and they are ready to buy the shares at a price of 215. So why would the company give it to me at 210? When the shares are being getting sold at a better price, at a higher price, obviously the company won't give it for a less price. So this is also one of the options that's being available when it comes to making an issue and raising the money from the public. And regarding price of frequently traded shares, so I think first we have to understand what do we really mean by frequently traded shares. So for example, the company has issued, let's say, 1000 shares and they are being listed on the stock exchange. So frequently traded shares basically means that in the past 12 months, at least 10% of the shares, like if the company has issued, as I was saying, 1000 shares, so at least 100 shares have been purchased or sold. So there has to be a transaction of 10% or more to qualify any company shares as frequently traded shares. If the shares of the company have been listed on any of the recognized stock exchange, but the shares are not getting traded much, or they're being traded for just about 5% in the year, like whosoever has got the shares, they're not really selling the shares, they're not really doing any kind of a trading, and the total trading in the entire year for the shares of the company in the past 12 months has been about 5% or even less than that, then you will qualify, or you will call that particular as probably a company whose shares are infrequently traded. So to get the tag of the shares or to get the tag as frequently traded shares, you have to make sure in the past 12 months at least 10% of the shares are being traded in the market. Traded means the shares have been bought and sold. So that's what has been mentioned here. So it says if the shares of the company are frequently traded shares, then how would we determine the price? Because it is not like that you can say that my share price, my company share price is like 500, and then somebody will say that it is 1000, and then some other company will come up and they will say it is 5000. It is not arbitrary. We cannot just keep that price which we want. I mean, as a promoter, as a issuer, the intention will be to keep the share at a maximum price. But then we also have to understand from the perspective of the investors, because ultimately the investor has to invest the money, and the investor is being investing the money and taking the risk, thinking that they will get something in return. The share price will increase or they will get a dividend, so on and so forth. So we have to balance that out, and there are few strategies or the ways as to how the price has to be determined. So it says if the shares of the company are being frequently traded, and what we already discussed, what do we really mean by frequently traded? Then it says we will have to consider the trading period for the past 26 weeks, which is technically like 6 months, but in the examination you will mention it as 26 weeks only. Do not mention as 6 months. For the purpose of explanation, I'm just saying that you can also remember this way, that it is kind of 6 months, but for examination perspective it is 26 months. So the price of the shares will be taken for the past 26 months, and depending upon like whatever has been the highest of the price that we will now discuss, we will call it as the price, or we will call it as a final price. So if the shares of the company have been listed for the period of 26 weeks or even more than that, then the price at which the equity shares will be allotted will be the higher of the following. Higher of the following means the average weekly high and low of the price of the shares that have been listed for the past 26 weeks. This is one parameter. The other is weekly high and low of the shares of the company for the past 2 weeks. So you have to compare between the high and low of last 26 weeks versus the high and low of the past 2 weeks, and whatever is higher, be it 26 weeks one or be it 2 weeks one, that will be the price at which the shares will be issued in case the company now want to go for issuance of the equity shares. So that's how the pricing will be determined. So I think that's what has been mentioned here. And there's also one of the calculations that we have included here, so you can do the calculation by calculator. So what we have done is, this is the maximum and this is the minimum price. So you see this is the final price, and then you see that 414 has been probably the highest price in this entire week, starting from 21st to 27 September. So I've written this as a maximum, and then minimum has been obviously about 387, and then we have just average it out. Average out means 414.28 plus 387.91 divided by 2, so you come to this figure. So this is like 1 week. So you have to do this for entire 26 week at one stretch, and then on the other side you have to do this for last 2 weeks, and then whatever comes as the highest, you will take that particular as the price for the issue of the equity share. So that's what has been mentioned here, and that's how the price will be determined. Now the question is, in case the shares of the company have been listed for sure, but they have been listed for less than 26 weeks, right? Because we are saying that in case the shares have been listed for 26 weeks, we will do what we have discussed above. But in case the shares have been listed for a period less than 26 weeks, then what is the procedure? How do we really determine the valuation of the shares? It says then we have to find out the valuation from the options given below. Like the valuation can be something like point number one, like whatever amount has been taken from the subscribers when the company actually brought the IPO, because this is not the IPO price, this is like an FPO thing, or a further shares are being getting issued. So we can consider, because the company is relatively very new, only 6 months kind of has passed, because we are saying less than 26 weeks. So less than 6 months, or about 6 months have only passed. So we will consider the IPO price that have been given by the company. So that's the point number one. The second thing that we can consider here is the average weekly high of the share price of their company for the past day. So it says the average weekly high and low of the volume weighted average price of the related equity shares quoted on recognized stock exchange during the period the equity shares have been listed. So for example, the equity shares have been listed for let's say 4 weeks now. So we will, rather than 26 weeks, because the company has been listed for less than 26 weeks and it has just been listed for 4 weeks, so we'll find out every week what has been the highest and then what has been the lowest. We'll do this for 4 weeks and then we'll find out what actually comes in. And the last thing that we can do here is to find out the average weekly highest and lowest for the past 2 weeks, and whatever comes the highest price, be it the price that the company has offered the shares in their IPO, the point number one, or if the companies have remained listed for, let's say, past 4 weeks only, then whatever is the highest price from that. And then the last is the highest or the taking out the average, the price that comes for the past 2 weeks, taking the calculation of the highest, weekly highest and weekly lowest, and then taking out the value as we discussed above. So out of these three options, we'll find out which is the highest price. For example, the shares initially were issued at 600, so this is the price the company issued the share in IPO. On the point number second, when we take the calculation of the past 4 weeks, like taking past 4 week highest price of the shares and then past 4 weeks lowest price, and then taking out their average, so it is coming, let's say, 555, and the last is past 2 weeks, which is coming as 530. So in this case, the highest is this price, so we will take this price, or we will keep this as the price for the issue of the shares. Further, if we talk about the Security Exchange Board of India sweat equity shares, I'm sure you're aware that sweat, as the word itself suggests, is a symbol or is a sign whereby the people actually do a lot of hard work. When we talk about gym, we talk about exercise, we actually talk about sweat, right? Because that really shows that you've been doing some exercise, you do jogging, you do running, you sweat, right? So you're working hard. So any employees of the company who really work hard and probably give the best to the company, not just 100% but 1000%, the company may issue them sweat equity shares in return of the efforts that the employee has put. So in regard to the pricing of the sweat equity shares, it says the pricing shall be the highest of the following. So here also we will find out of two options which is the highest, and then that will be the price for the issue of the sweat equity shares. The average weekly and high and low of the closing price for the past 6 months, or the average weekly high and low for the past 2 weeks. So whichever is higher out of this will be the price for the issue of sweat equity shares. Like sweat equity shares are being given to the employee, but they are not being given for free. They are not bonus shares. It's just like they are being given to the employee, and they will be given at some kind of a discount. So it's not like, because otherwise if the shares of the company at the market is rupees 600 per share, and you are offering the same shares to the employee saying it is 600 per share, so I mean, even if you don't offer, the employee can still buy it from the market. So you have to provide some discount, then only the employee will buy, right? Because on the one hand, you are saying that the employee has really worked hard for the company, and you wanted to reward him by giving some shares of the company. But then if you've been giving him the shares of the company at the same value on which they've been listed on the stock exchange, then these are two contrary things. On the one hand, you are saying the employees really work hard, and then you are offering the shares at the same price. So that cannot be true. And then why would it be called as sweat equity? If the employee wanted to purchase the share at this price only, he or she could buy the shares from the open market also, right? So I think we have to consider all those factors. Moving forward, we have company share capital and debenture rules 2014. It says the sweat equity price will be determined by the registered valuer, and the valuation will also be considered on the basis of the fact that what employee has contributed. So, for example, let's say there are two employees. Now, Mr. A has given 3 intellectual properties to the company, which is 2 patents and 1 copyright. On the other hand, there's an employee called as Mr. B, and Mr. B has also given some intellectual property to the company, but since A has given, like as I said, 2 patent and 1 copyright, B has just given 1 patent, right? So I think we will have to consider, it is not just like somebody has given 3 patents, so they will have more value, and somebody who's given 1 patent only, he will have less value. It's not like that. We have to analyze as to which patent has more value, and then accordingly we will have to offer the price to them. So I think all of these factors are also essential and will be considered while determining the final value for the sweat equity shares. In regard to the valuation strategies for mergers, so I think we discussed all of these sections previously as well. When we talk about merger, we just not talk about the Companies Act, but we talk about NCLT, we talk about the rules, the income tax, the stamp duty, the Competition Act, the SEBI LODR when the company is specifically a listed entity. And in case the company is being governed by some sector regulator, like we discussed above, it is a company to do with telecom, so TRAI comes in. If it is a company to do with banking, RBI comes in. If it is a company to do with insurance, IRDA comes in, so on and so forth. So all of that needs to be accounted for and needs to be accommodated before we really go ahead and do any kind of, even prepare for any kind of mergers or amalgamation. Now, talking about the section which we did even previously, section 230 really talks about the powers of the tribunal to actually, the powers have been given under this section, that there are chances that in case the company wanted to enter into any kind of a compromise or arrangement agreement with the members or the creditors or the class of them, they can do that. And then section 231 talks about the powers of the tribunal. So 230 really talks about the arrangement between the company and the members or the creditors, while 231 talks about the powers of tribunal. So I think this is how it works, because I think we discussed this previously as well. It's not just like tribunal, sanctioning the scheme. Tribunal, while sanctioning the scheme, will definitely consider the majority perspective, but then it should not really exclude the perspective of the minority shareholders. The tribunal has to keep in mind the stake or the point of view of the minority stakeholders as well, because for sure the majority, since the name itself suggests, there are many people on one side, and that's why we call it as majority. So there are chances the majority is being trying to do something which is against the interest of the company, and the minority is being trying to protect that. So the overall factor has to be included and considered. Having said all of that, I think I mentioned this previously, that there cannot be any scheme which will be agreed by probably 100% people, right? There will be some differences, which is perfectly fine, which is, I think, the basic of human nature. You will have some difference with others, some people will have difference with you, and that's perfectly fine, and that's how life goes, right? Be it professional life, be it personal life. So that's very, very common. So I think the tribunal will consider all of that and then finally put a stamp on the scheme. But before that, when we talk about these kind of sections, so compromise and arrangements basically is a strategy whereby the company will be reorganized or reclassified. Probably the shares will be subdivided or consolidated depending upon what is best for the company, and this will be between the company, the members or the creditors, and depending upon what agreement has been reached between the company members and creditors, the application will be made to the tribunal, which will be under section 231. Now, when the application went to the tribunal, so it says when the company make an application to the tribunal, they will have to disclose by way of affidavit that they have given all the information to the tribunal which is true, fair and correct, and the company probably the scheme that the company is being trying to enter in the form of compromise and arrangement has got the consent of the members, because as we said, section 230 really starts from the fact where we say that there has been some special arrangement between the company, the creditors, or the company or the members, or the class of them. So all of that need to be mentioned to the tribunal, because tribunal, unless it is an exception, will not sanction any scheme which is not in which is not being consented by the members. Law, there can be exceptional cases as well whereby the tribunal can do anything, the central government can do anything, but in general cases, unless and until this has been approved by the majority people in the company, the tribunal will not move ahead. The tribunal will consider as to why the people are not being agreeing, and what are the pros and cons, and accordingly move ahead and decide the case. Subsection 3 says about the notice of the meeting. When the documents like the declaration etc. that the member consent has been taken has been submitted to the tribunal, then the tribunal will ask the company to call the meeting of the creditors or the members as the case may be, and then the company will send the notice to all the concerned that this and this is the date that has been decided, and to discuss about the compromise and arrangement. And along with the notice of the meeting, the supporting documents in the form of the valuation report and the other explanatory statement will also be given, so that the people who be coming to the meeting will have a fairly idea as to what will be discussed in the meeting, and accordingly can take decision. The same will also be provided to the members who cannot come physically, so they can either send somebody as their proxy, or probably can vote via postal ballot as well. This is also one of the example in front of you, which is IL and FS engineering services. So you see that here they say that you can do the voting by e-voting or the postal ballot, and it says that this is a related party transaction and what other information has been given. So the same kind of information, depending upon the items that we are going to discuss, need to be given, so that the members or the creditors get a fair idea and accordingly take their decision on that line. So the notice seeking the consent from the members or the creditors needs to be sent to them, and then it will have the option that either those stakeholders to whom the notice has been sent can come themselves, or can appoint their proxies to vote on their behalf. Other than that, I think we discussed this earlier as well in terms of the objection as to who can raise the objection. So anybody who is owning more than 10% of the shares in the company, or in terms of the creditors, whosoever has given a loan or probably an amount to the company which is like 5% or more of the total debt. For example, the company has taken a total debt of rupees let's say 100 crores, and you are a person who has individually given the company 6 crores, right? So I mean the total debt is 100 crores and you have given 6 crore, meaning that you have given about 6% of the entire debt. So you can also oppose the scheme. So those who hold 10% or more of the equity shares, or 5% or more of the total debt that the company has taken, can raise objection if any. In terms of the regulators, I think we discussed this earlier, depending upon like the company, because every company may have a different sector regulator. Like specifically, I think I discussed about discussed about the banking sector, discussed about the insurance. So they also have a regulatory authority, which is I think beyond the normal authorities that we generally have, like an income tax or probably the ROC, because these income tax ROT are very common and probably gets applicable to every company. So the notice will also be sent to all the regulators, so that they can also raise the objection if any, because once the scheme is being sanctioned, I think it will be very difficult to change anything. So we wanted to make sure that everybody who is being associated with the company directly or indirectly gets the notice of the fact that some compromise or arrangement or probably corporate restructuring is being happening in the company. In regard to the approval and sanction of the scheme, so here comes the important questions, like what amount of people support do you really require? So the purpose of holding this entire process and doing meeting is to gather the support. So we're saying that we have to have the consent of the majority, and here the majority is not the ordinary resolution but kind of a special resolution majority, which is like 3/4 in numbers. So we have to have the consent of at least 3/4 people who are being present at the meeting to pass this compromise or arrangement, as the case may be. And once this is being passed, it gets applicable to the company unless and until there are some factors whereby it's being proved that this scheme is against the interest of the company or against the interest of the minority. So that's really an exception part, but we do require the consent of at least 3/4 members or greater as the case may be. In regard to the tribunal sanctioning the scheme, when the tribunal actually sanctions the scheme, it will not just look for the 3/4 majority, but it will also look towards the interest of the company, towards the interest of the stakeholders, because all of this compromise and arrangement is being done with a view to benefit the company at large. So being the tribunal, it has to be analyzed whether or not that particular purpose is getting fulfilled or not, because even if doing all of this hassle and the result is nothing, the result is zero. So I think this is not the viable option to do. So I think the tribunal will consider everything, even in regard to the dissenting shareholders, because sometimes you see that in your personal life, in professional life, there will be few people who will not just agree to anything. There are some people who have a valid reason. They have a disagreement, that's fine, but they do have a valid reason for that. But then on the contrary, there are few people who really disagree with everything but does not really have any kind of a valid point, right? Most of the time they don't have the valid point. So we are really not concerned with the second category, but we are concerned with the first one, that who are dissenting and really have a valid and a genuine point. So the tribunal will also consider that and accordingly pass the order or the judgment. Once the tribunal order has been passed, the company has to file the same with the ROC so that the ROC can update their records. And normal protocol definitely says that the company has to hold the meeting of the creditors and the members. But in case the company says that they have already got the consent of 90% of the people, they have got the consent of 90%, which is obviously above 75%. So in that case, the tribunal has a power that the tribunal can exempt the company or probably dispense the company from the requirement of holding the meeting, because the company is saying that they already have this much support, right? So even if, let's say, if the support is 95%, then there are very less chances that you will find people opposing. 95% people are supporting the scheme, and here you see the section interpretation says that tribunal may. So it is not like even if the company have 95% support, the tribunal may still ask the company to hold the meeting and follow the entire process. But we are saying if the company has this much big number in their favor, then there are chances, if the tribunal thinks fit, that they can exempt the company from holding this kind of meeting. In regard to the company compromise arrangement rules 2016, which talks about the documents that need to be filed with the NCLT while filing the application. So they says that the form once gets filed with the tribunal in the form NCLT1, along with that some documents in the form of affidavit and the form of notice or probably an admission that the company has prepared all the accounting practices as per the accounting standards. The copy of the schemes or the arrangement etc. needs to be attached along with the application that will be filed with the tribunal. Plus, when we talk about all of that, I think the applicant or the company will also provide to the tribunal the highest price that has been paid by the acquirer to acquire the shares of the company, or the second thing is that what is the value of the shares as per the registered valuer. Maybe the registered valuer says that the shares of the company are worth 500 rupees per share, but the acquirer is being paying 550. So that is really good for the dissenting shareholders, because dissenting shareholders will normally get 500 rupees as a share price if they sell the shares in the market, but now the company is being paying them above the registered valuation price, so that's really good for them. But if it is the other way around, that the company market share price is 550 rupees, market share price is 550 rupees, but the registered valuer is saying 500, so definitely this is a question, because in this way dissenting shareholders probably will be at loss if they give the shares to the company, and everybody will be at loss, because normally the market price of the share is 550, so why would somebody give the shares or sell out their shares at rupees 500? So all of that will be considered, and I think it will help the tribunal to actually examine and decide the case. In regard to this further, as I was saying, the affidavit has to be filed. An affidavit is nothing but a mere declaration which certifies that whatever has been mentioned in this entire petition or the application is true, fair and correct. So that has to be done also. And when we say about this NCLT form, I think affidavit has more to do with the facts and figures, that whatever you have mentioned in the scheme of the compromise or arrangement, or whatever you've been saying, that these many people have agreed with your scheme. So all of that should be true, fair, and correct. Later on, nothing should change. The company or the director should not change their statement later on. So that is why the documents are being taken in the written form, and this is called as an affidavit. Uh, Apart from that, the sector regulators also need to be informed. But I think prior to that, we also have to make sure that Form CA2, which is a kind of a form that will be published in the newspaper, like kind of an advertisement in the form of notice, that the tribunal documents etc. have been filed with the tribunal, and now the meeting to consider the same will be happening on this and this date, this and this time, and accordingly what will be the decision of the majority will be conveyed to the tribunal. So this notice will also be published in the newspaper, so that public can be made aware far and wide that some kind of a corporate restructuring or realignment is about to happen in the company. I'm sure when we talk about all of this, I think in newspaper, if you try and look out, you'll find these kind of notices very, very common. But I think unless and until it affects me or you, we will not be really bothered as to what is happening. I mean, it is really good from the perspective of knowledge and everything. That's one side of the story. But unless and until our personal stakes are involved, maybe we'll not have that much interest. The reason I'm saying is that it's not new to have or probably find these kind of notice in the newspaper. You will find these kind of notice in the newspaper very, very often. So this notice has to be published. Other than that, the notice has to be sent to the members, like, or the creditors, at their address with the company, and this notice need to be sent at least 1 month prior to the date of the meeting. And when we send this notice, we will definitely mention the date, time, and venue of the meeting. Along with this notice, the details of the company, the SIN number, the date of incorporation, registered office, stock exchange, where the shares of the company are being listed, name of the promoters needs to be included. And apart from that, I think we'll also try and find out as to why this entire thing is being happening. I mean, if, for example, I've taken the shares of XYZ company and now I get the notice that the company is being doing some kind of a compromise and arrangement. If I'm a company secretary or and kind of a person who knows about this, maybe I'll have some idea. But if I'm a layman, I need to understand what I need to do with that and what are my benefits, right? So all of that will also form the part of the explanatory statement. The board will actually present a brief as to how this entire thing will be beneficial for the company, what will be the valuation of the shares, then what effect will this entire exercise have on the functioning of the company. So all of that will definitely be mentioned in the explanatory statement. Other than that, since this is the stage whereby we've been asking the stakeholders to vote, to come and vote at the meeting, but prior to this, I'm sure the board of directors must have done an initial discussion. So how many directors at that particular point of time were in agreement of this entire scheme, and how many of them really oppose that? So I think all of that needs to be mentioned here, so that those who have been coming in the meeting can have a fair idea as to what board actually think about these kind of things. So that's what has been mentioned here. Apart from that, I think I just mentioned, I think just now, that it's not, giving the notice to the members of the creditors, but we also have to make sure that we don't ignore the regulators. So when it comes to regulators, we have written down various authority who can be the regulator, but I think the list is an inclusive list, and probably various things or various other authorities can be added to it. But we have listed here the very, very normal, very, very basic statutory authorities that are being generally applicable to almost all companies, like the ROC, the income tax. It's being written in all cases. So depending upon if your company is a banking company, then obviously RBI gets involved. If the company is a listed company, SEBI gets involved. Stock exchange also gets involved if the shares are being listed. CCI gets involved. So all of that. So these are the very general or the generic statutory agencies that we have written. But definitely, as I said, this list can go on and on, because depending upon who the sector regulator is, we have to include their name as well, and the notice will also be served to them. Once it is being sent to them, they will be given time to reply to it, just like a normal stakeholders who will be given a 30 days time period. So I think this entire thing will be sent to the statutory authorities, and then the statutory authorities will have a time to make their recommendation. If they didn't make the recommendation within a specified number of days, then it will be taken by the tribunal as if the statutory authority has no objection and they have nothing to say at all. So this will be approved from their side. So this is practically, I think, everything about section 230, the way the tribunal actually begins the process. And now when we come to section 231, I think we'll talk about the powers of the tribunal as to what tribunal can do in this regard. So this 231 really talks about the powers of the tribunal, and the powers of the tribunal can be categorized like the tribunal has the power to obviously sanction the scheme, and not just to sanction the scheme but also tribunal has a power to actually give necessary directions so that the scheme can be properly implemented. So basically the ultimate supervision of the scheme can also be done by the tribunal, and since the scheme will be sanctioned by the tribunal, so tribunal has a duty and towards all stakeholders to make sure that until and unless the schemes prove to be in the best interest of the company, the tribunal will not sanction the scheme. Moving forward, we talk about section 232, which is about mergers and amalgamation. I think we did talk about what are mergers and amalgamation and how they are different from each other previously when we started this entire course. So it's being said here that section 230 talks about the documentation etc. that needs to be filed. So when all of that goes to the tribunal will try and analyze if everything has been mentioned, the documents are being true, fair and correct. And if these scheme which has been presented to the tribunal actually gets sanctioned, who will get the most benefit, whether it will be the companies or the stakeholder or some promoters or some KMP. So depending upon the answer to that, I think the scheme will move ahead and the question will be answered as to whether or not the scheme should be sanctioned or not. So I think this has been mentioned here. And when we talk about the circulation of document for members and creditors meetings, so it says the draft, as we discussed, the draft of the scheme that has been approved by the directors will also be filed with the ROC, and the same will also be given to the tribunal. And then the same draft will also be placed before the members or the creditors as the case may be, and once it is being passed at the meeting of the creditors and the members, the same will be informed to the tribunal, and the tribunal will put a seal, a final seal, that this is the final conclusive and the binding compromise arrangement agreement. So that's how this entire process works. In regard to the scheme, I think the consequences, the entire process of the entire exercise, the result of this entire exercise may be as follows. Like for example, there is a company called as A and then there is a company called as B. So if there is a kind of a compromise and arrangement between these two companies, and it's being said that after this restructuring, all the so A we will call it as transferor company and B will call as a transferee company. So in the scheme it's being written that once the scheme is being sanctioned, all the assets, all the liabilities, all the employees, all the contractual obligation, all the legal obligation, etc. of the transferor company will become the obligation of transferee company. So once actually the tribunal sanctioned the scheme, whatever has been just said in regard to the contractual obligation, in regard to the assets, liability, employees will be in effect, and whatever is being applicable to A, moving forward it will be applicable to B, and it will be deemed as if the initial starting of these contracts were also done by B only, although in practically it was done by A, but now A has merged with B. But we are saying that now moving forward we'll assume that although this has been practically contracts have been entered by A at the very start, but it will be now assumed that everything has been done under B's name, and B will be held liable, accountable for any of the loss or any of the benefit arising out of those contracts. Now, in regard to the date from which this entire scheme will be effective, that will be called as an appointed date. So basically appointed date is the date from which scheme will be effective, and this is up to the parties to decide the appointed date. They can also say is that the date the tribunal sanctioned the scheme, that can be called as an appointed date for an example. So whatever has been decided by the parties will be termed as an appointed date, and it will be duty of the professional like a CA, CS or CMA as the case maybe, whosoever has been employed, to file the necessary reports with the tribunal until this entire scheme actually gets sanctioned. Because see, when we talk about the things like in terms of the big corporates, it's not really that easy, right? Because you have to get the consent of so many people, you will get so many queries, and I mean the queries cannot just come from the creditors and the members, but they can also come from the statutory authorities, as we discussed. So asking queries, giving answers, and so on and so forth take really a lot of time. So if it is taking too much time, the certified professional, which is CSCS or CMA, will keep on reporting to the tribunal on whatever scheme, whatever parameters, or on whatever parameters the scheme has been initially approved by the tribunal. It's been going on that way only. There has been no change in the way the scheme was implemented or will be implemented. So I think this is the entire ideology behind these sections. I think we already talked about the mergers and its type previously, so I'll not repeat that again. And now we'll move on to section 233, which is mergers and amalgamation of certain company. So this basically is a simplified procedure, also called as a fast track merger. Fast track merger, or probably section 233, talks about the merger between two small companies or a holding and its own subsidiary company or other classes of company has been prescribed by the government. So there will be few companies who will not be trading on a very big scale. They are not listed, or let's say they are just like group entities holding and subsidiaries to each other. So I think we'll follow the provision of section 233 in that regard, whereby this entire process can be done, and a lot of paperwork, etc., approvals, etc., will not be needed, because this is a fast track process. So various things will be cut down, and only essential part of the things will be followed here. So the entire process of the fast track is being divided in this way. But before we do that, let's try and analyze the definition of small company. Now, when I say the definition, this definition of small company keeps on changing. The government actually keep on doing the amendment. So at the moment, this is the definition. But with budgets coming and everything going on in the economy, the government tries to tweak means change or amend the definition as applicable, but the entire crux of the section won't change even if the definition gets changed, right? So it says the entire process works this way. Hi guys, welcome back. My name is SHANTANU. So now we are discussing the fast track batch in complete English for the subject called as CRIV, corporate restructuring, insolvency, liquidation, and winding up. And now we are we are on the chapter number 4, which is also called as a process of mergers and acquisition. And in this, we have really discussed a lot about various sections. Now, in this class and onwards, we will try and discuss about the section 233, also relates to the fast track merger. So in the last class, I was talking about the definition of the small company, saying that the definition may vary because the government really has the power to change the definitions. So at the moment, as it stands, it's just like the fast track merger is possible for between the holding and the subsidiary, or let's say small companies. And this is like one of the feature whereby without much hassle, or probably I'll say the key or the underlining point is that you really don't need to go to the NCLT or application for this entire procedure. Will be between the ROC, official liquidator, and that's how this entire process is being defined and confirmed by the central government. Now, when the application goes to the central government, and if the central government is of the view that it requires the probably a suggestion from the tribunal, it may forward the application, and the tribunal then may consider this, saying that this is not a normal, this is not a fast track merger case, and this should be referred as per the provision of section 232 like a normal process of merger. So that's a different scenario, but normally speaking, it just starts with the way that the company transferor and the transferee actually decide that they wanted to do this entire process like the mergers. They meet and then they finalize a draft schemes, and the draft schemes is being sent to the ROC and the official liquidator. The declaration of solvency which certifies that both the companies are solvent, like they are able to pay their all the debts as and when they become due, and this entire procedure of the mergers is not being done to avoid any kind of liability whatsoever, because we are aware, be it a normal merger or this mergers, I think I've told this previously, that be it assets or liability, entire thing that's been there on the transfer company get transferred to the transferee company. So there is no question of escape whatsoever. But then the declaration of solvency is just another step by the company, both the company's transferor and the transferee, to certify that yes, they are not doing these things, or they're not being actually using this provision to violate any of the sections or the rulings. So once a declaration of solvency is being filed, the meeting notice is being issued to all the concerned stakeholders, and depending upon any of the recommendations that are being received by the ROC or the official liquidator, that suitable adjustment are being made in the scheme, and the scheme is being presented to the stakeholders. And if it is being approved by the majority, then definitely we will let the central government know. The central government will actually talk about the scheme with the ROC and the official liquidator, and depending upon any of the suggestion or the recommendation received from the ROC or the official liquidator, the central government may seek the consent of the tribunal as well, like NCLT. In case NCLT, as I said, does not raise any objection, then the scheme gets approved. But if NCLT says that this is a normal case and should not be treated as a case of section 233, then this application will now again go back to the company, and the company will be advised to take this application as a normal route in terms of the provision of section 232. So the basic point of this entire process is that the requirement of going to the NCLT has been dispensed with. So you really don't need to go to the NCLT and file all the forms and do all the paper or the advertisement in the newspaper. So all of that requirement has been dispensed with. I think that's the best part of this entire process, and this has been done to make sure that the small companies or those companies who relatively does not have much turnover probably need not to go and follow the entire lengthy procedure. Now, talking about the other subsections that are there in section 233, so it just says that the scheme, whenever it's being entered between the entities, this has to probably, as I explained above, has to take or has to go through the process of ROC and the official liquidator. Like a scheme needs to be sent to them, a draft of the scheme needs to be sent to them, and they will raise any objection or give any suggestion as required, and accordingly those suggestions needs to be fit in the scheme, and then it will be circulated to all the stakeholders. The central government, as I said, will definitely take the view of the ROC and the official liquidator before putting a final seal and approving this entire fast track merger. The whole idea or the whole concept is that those companies who are relatively small, as I just said, should not be bound or should not be compelled to follow the cumbersome procedure or probably a lengthy procedure which anyway is not required. Apart from that, it says section 233 subsection 6 says that on the receipt of application from central government or from any person, if tribunal for the reason to be recorded in writing is of the opinion that the scheme should be considered as per the provision of section 232, the tribunal may direct accordingly. So it's just the way that the tribunal will not interfere directly. The tribunal will not say that this is not possible. But if the central government or any of the concerned stakeholder who is getting affected or even not getting affected asks the tribunal for the opinion, the tribunal will definitely intervene and guide the correct method as applicable. Once this entire I'm sorry. So once this entire process gets approved, all the assets and liability of the transferor company becomes the assets liability of the transferee company. All the legal or the cases pending on the transferor company becomes the cases that will be continued in the name of the transferee company. So that's how this entire process work. And apart from that, we can see here that the normal provision from section 230 to 232, as we discussed above, have been outlined here in the form of the chart, which really starts from doing a board meeting and obviously move ahead. But when we come and talk about the provision in regard to section 233, all of this really does not get applicable, because as I said, the provision of requirement, the provision or the requirement of going to the NCLT and filing all the forms have been dispensed with, especially when it comes to the fast track merger as per the provision of section 233. But talking generally, like the normal companies which does not really fall under the definition of small company and has no relation of holding and subsidiary with each other, for them this entire process which we discussed above when we were discussing the provision of section 232 needs to be followed. Talking about section 234, which talks about mergers amalgamation with a foreign company, also called as cross-border mergers. So basically this entire thing can happen, but there are still a lot of questions around these provisions, but the government really has introduced, because it's, I think in life also, I mean, if you see, normally you see that I take some of the examples that are being related to our practical life, because I think when it comes to us, when we are facing that situation, we are able to understand in a much better way. So if you have a question in your mind, it is not necessarily about your career, about your relationships, about your family, just anything. It is not necessary that you'll get all the answers. Sometimes time will give you the answers. Sometimes when you step ahead and go on ahead, then you will keep on getting the answers. If you say that I want the answers, all the answers at one go, and then I will start the journey, be it relationship, be it career, or be it just anything in your family as well. So I think you will be left there, because you will not be in a position to get all the answers every time before you start. So I think this is what gets applicable here as well. We really don't know the future outcome of this section, but at least it is the fact that something has now been inserted in the provision of the act, which was earlier not there at all. So at least we have a section, and then we have a rulings and the rules around the same. So in case the Indian company wanted to merge with an outside company or an overseas company, or vice versa, this section needs to be followed. Since the countries are getting involved, money is getting involved, money will either come in or go out, or vice versa. So the provision of RBI will also gets involved, and this is not just applicable to the inbound merger but the outbound mergers as well. So you cannot say that this section is just for the fact that overseas with the foreign companies getting merged to the Indian company, but it is also the other way around. The Indian companies are being merged with the foreign company, then also this section will prevail and will do its purpose. So we'll have to identify what are those countries with which government has issued a notification with which the Indian companies are allowed to get merged, because there may be some countries or probably some places which are being regarded as tax havens. I'm sure you must have heard Mauritius is one of them. But then there are other countries as well with which the government is not really sure. There are links of black money and terrorism, etc. So the government may restrict the Indian companies to merge with any of the companies that's been located in that country, and vice versa. So I think all of that needs to be considered before we move ahead with this entire process. There are some critical issues around this, which talks about the fact that RBI notification are still awaited, and a lot of clearance are being required from RBI about this entire process. Then tax applicability is also one of the questions that need to be considered and analyzed carefully before we really move forward about this. And then there is no process as such for the fast track. So I mean, this has to follow the normal process of section 230 to 232 that we discussed above, like previously. So the provision of fast track really does not get applicable, which means you have to go to the NCLT and do all the necessary compliance as required as per the provision of section 230 to 232. Now, talking about the powers to acquire the shares from the dissenting shareholders. So dissenting are those who are not ready to give their shares to the transferee company. So it says if the transferor, let's say there is a company called as A, and then there is a company called as B, right? So this company A company has already acquired 92% shares. So we say more than 90%. So I take it as 92. It's more than 90. So it says the A should have at least 90%. So I'm saying that A has already acquired 92% shares of company B. Now only 8% is being remaining. So 8% shareholders are being dissenting. 8% shareholders of B are dissenting, and they are not ready to give their shares. So they will be termed as a dissenting shareholders. So the dissenting shareholders will need to be given a notice. I think we discussed all of that in the previous chapters. There was a format as well. We will give them a notice from the side of company A that 92%, as in this case, or whatever, 90%, 91%, it has to be like kind of a minimum 90%. So we'll say that company B 90% shareholders, or in our case 92% shareholders, have already given the shares, and now as per the process of law, we are bound, or probably are in obligation to acquire the rest of the shares, which is 8%, 10%, whatever, depending upon how many you have already got, be it 90 or 92%. So the dissenting shareholders can probably take the amount of per share, which is rupees this much and this much, whatever the valuation is. Alternatively, if the dissenting shareholders have any objection in regard to the scheme, they have the option to go to the tribunal. But then when you even talk about going to the tribunal and raising objection, you have to be aware of the fact, I'm sure you are, that you have to have at least minimum 10% shares. So I'm saying that the company has already acquired 92%, so obviously the remaining is only 8%. So that criteria does not really meet up, right? So they cannot even raise objection because they have less than 10%. The other is in regard to the debt, and the debt percentage should be 5% of the total outstanding. So that's still open if the creditors are there which are owning at least 5% or more of the total debt of the company. But anyway, so dissenting shareholders will be given an option to acquire, to take the amount of the per share which is being determined by the registered valuer and give their shares to the acquirer. So that's what the entire process is all about. In regard to the minority shareholding, so minority is always of the view that who are not agreeing with the decision. Like you can see in this picture, majority are being standing on one side while there's just one person who is being standing on the other side. So I think this is the perfect example of minority. And I'm not saying, I mean, the normal rules definitely says that majority prevails and majority is always correct, but I will not say it as in 100%. So it is not true always. This particular one person may be saying correct, and just because he or she is alone, we cannot just ignore his thoughts or her thoughts altogether. We have to have some consideration on this as well. So depending upon what the minority shareholder has to say, it will be heard, and if it is valid, then the necessary course of action will be taken. Else the minority shareholders will also have to give their shares. And do not think that we are saying that when we are saying they have to give their shares, they're not giving their shares for free. They will be offered a reasonable value, right? So they are not, it is not something that we are being pressurizing them to give their shares for free. It is not like that. The acquirer has a ready cash and the acquirer is ready to offer them the cash. It's just like the minority. The reason they've been calling as a minority is because the minority is not agreeing to a particular decision which majority has already settled and agreed. So that's what minority is all about in this case. In regard to the powers of the central government to order amalgamation in public interest, so central government definitely has those powers to do that. If they think in the public interest, in the interest of community, in the interest of the company, in the interest of the stakeholders, it is needed. The central government can by itself, rather than following the process of preparing a scheme, going to the NCLT or not going to the NCLT, and objections and those newspaper advertisement. Central government can initiate all of that by its own and pass the orders for the amalgamation of two or more companies. But when central government does all of this, the central government has to be mindful of the fact that the creditors or the members' rights should not be affected. For example, I am the creditor, like I have given, let's say, a loan to the company, or let's say I have a deposit with the company, like as the case may be. So basically, I am a stakeholder and being involved in the company. I have given a debt to the company worth 1 crore. So even if the company orders the amalgamation between two companies, I as a creditor should still own 1 crore. It should not be like that post amalgamation, I have given pre-amalgamation 1 crore rupees debt to the company, and post amalgamation it got reduced to only 70 lakhs. So why should I bear the loss of 30 lakh rupees? So it should not be like that. I mean, there will be some chances, that the debt will be adjusted and the equity will be adjusted, but it has to be only a proportionate amount. It cannot be just a reduction of 30% in a straight way, right? So I think the central government will definitely consider all of these points. Plus, it is being said here that the no orders in regard to the entire process of ordering by the central government will be sanctioned unless a copy of the draft has been proposed draft have been sent to all the companies involved, and then there will be a time that will be given to the company to actually appeal against the scheme of the central government or against the scheme that is being suggested by the central government. So let's say a 30 days time period has been given to the company to file an appeal in case they are not agreed or they are not happy with the scheme that are being sent by the central government. So this 30 days should be over before the scheme finally gets sanctioned. And in case this 30 days is still alive, then the company definitely will have the option to go to the NCLT or NCLAT and file the appeal saying that this is not correct and the central government cannot do that. So once this entire process of 30 days, 45 days, 60 days, whatever days have been given is being over, then only the central government will move ahead and pass the final order. Till then, the orders will be termed as a draft orders only. In regard to the preservation of the books, so those companies who are being doing this amalgamation, their books need to be preserved unless and until it has been approved by the central government to dispose them of. Liability of the officers in respect of the offence committed prior to the merger. So those liabilities stays the same, like they shall continue. It is not may, it's shall. Because as I said when we started this entire class, as I said, the entire process of doing this amalgamation and everything is not to bypass the liability. You cannot do that. Entire liabilities, entire assets, entire everything is being getting transferred, just everything. So if you are thinking that the company is being the company called as A is being getting merged with a company called as B, and after the merger it will be just a B company, A will lose its existence, that is correct, that is the case. But then B will be held accountable for everything that A has done prior to the merger as well. So whosoever officer were involved when those wrong things were happened in this company A, those officers would still be remain liable even if they have resigned from their position. It's not like they have to continue. When they have resigned, they would still be held liable for anything that have happened during their tenure. So this entire process should not be taken that way, that if you follow this you can bypass your liability. It's not like that. Further, it says approval of in scheme of amalgamation. The company are required to obtain approval in respect of scheme of amalgamation, and the authorization will be in the form of audit report and all the registered valuer reports. So they will also give a green signal that whatever accounting policies have been followed, or whatever process have been followed in terms of keeping the accounts and the provision are due in compliance with the provision of law. The board of directors have to agree. I think we already discussed the shareholders and the members also have to pass the resolution, and then only it will be termed as a resolution by which this entire process will take place. So it's not just the NCLT or the ROC or the official liquidator or the central government that can do all the things. It is an activity whereby the joint contribution is being required by all the stakeholders, starting from the board of directors to the shareholders to the members to the statutory or the regulatory agencies. Talking about the approval of the financial institution, which will be needed in case the company has taken any loan, because if the company has not taken any loan from the bank, then bank really does not have any right to interfere. And I'm sure you're aware that there is a provision of appointment of a nominee director as well in case the company has taken a loan from the bank. Now that's a different thing whether or not bank appoints a nominee director or not, but I mean there is the provision. So if the company has taken a loan from the bank, then the consent or the NOC from the financial institution is also needed before this entire mergers or this entire amalgamation can take place. So it says about authorization that the authorization will be required, and not just the bank but anybody that's being involved in this entire process, be the intermediaries or the bankers or any of the compliance officers, their consent is also being needed. And we already discussed about the approvals from the board of directors, the stakeholders, the members. In case the company is also listed on the stock exchange, then the stock exchange consent will also be needed, meaning that if probably this entire scheme is being happening, so when we talk about taking the approval from the statutory or the regulatory agency, stock exchange will be one of them which will also get the scheme and will definitely have the chance to oppose it in case it thinks that there's something wrong. And finally, we all know that a tribunal really has an important role to play. So I think this is pretty much everything that we have discussed in the previous sections as well. I mean, you have to be considerable about the point that you've been doing something really very big. You are being probably killing one of the company, and anything and everything that's being there inside the company, anything, I'm repeating again, anything and everything that's being there inside the company is being taken over or being given to these other companies, like the second or whatever company called as transferee company. So we have to make sure that we do it right, and we informed everybody that's being associated with that company, directly, indirectly. We have to inform just everybody, and has to give a fair chance to everyone associated with the company, directly or indirectly, to raise their point of view or to raise any suggestions or recommendation in case they have one. And then depending upon what the majority says, generally the decision will be taken. So talking about the steps, I think we discussed this previously, but it says again the steps with regard to the mergers amalgamation in the form of the flow chart. So I think this process will again start with the probably a scheme or probably a discussion, I would say, between the board of directors that they wanted to do this. On the basis of that discussion, some kind of a scheme will be formulated, also called as draft scheme, and then it will be sent to the audit committee for their recommendation and suggestions. Once the scheme is being approved by the audit committee, the board will finally, depending upon what recommendation have been received from the audit committee, the board will finally finalize the scheme, keeping the recommendation in mind. The scheme will then be actually sent to like the stock exchange as needed if the company is really a listed company, and will also be given to the NCLT. Obviously the forms and all will also be filed along with the schemes and the affidavit saying that the company knows that what they've been doing and they are not doing to bypass any kind of liabilities as we discussed above, because that will really not solve the purpose. Liability would still come to a new company. So the scheme that has been approved initially by the board of directors and audit committee will be filed with the NCLT. Along with that, the copy of the scheme will also be given to the regional director, probably ROC, official liquidator, and the shareholders and the members. So when this will be circulated to all these stakeholders, we have to be considerable of the fact that when we first file the scheme with the NCLT, we have to when we first file the scheme with NCLT and NCLT suggests any changes, we have to do those changes first, and then only the scheme has to be circulated to all the concerned stakeholders. Once the scheme has been given to all the stakeholders, a date of the meeting will be fixed, and on that day the meeting will be called. If 90% of the members who being present or the creditors being present in the meeting approve the scheme, the NCLT may probably dispense the requirement of doing a further discussion or a meeting, because if 90% have really agreed to that, then NCLT may not really go into much details. But we are using a word called as may, which means that even if everybody has been agreed, still NCLT may actually probe the scheme and try and find out more about it. So if the members meeting has been done and let's say 75, 80 or even 90% agree to that, the NCLT will be brought to know about the final outcome of the meeting, and depending upon that the NCLT will pass the final order, and then the final order will be given to the ROC as well to update their records. So this is kind of a basic overview as to how this entire process actually works, but we also have to be considerable about the fact that when we do all of that, we have to make sure that both the companies which have been getting amalgamated or merged, their MOA should allow these kind of provision. If not, we have to really amend the MOA first. Then since A company is getting merged to B, then what will happen? Like all this will be mentioned in detail in the scheme only, and that's what the total purpose of the scheme is all about. So in case the company is getting merged to B, then what will happen to the employees of company A? What will happen to the shareholders or the creditors of company A? All of that has to be considered and form the part of the scheme and has to be clearly mentioned, so there is no ambiguity and there is no question at the later stage. So all of that needs to happen, and obviously then as we discussed above, the regulatory agencies need to also give their opinion on that, and depending upon what has been said by the majority and depending upon what comments have been received by the statutory agency, final decision will be taken by the NCLT, either approving or disapproving the scheme or probably suggesting any changes. So that's what has been written here. In regard to the jurisdiction of the tribunal, which is the next topic that we have to start. So as we know that since India is being expanding and the corporates are being expanding by leaps and bounds, so it's really necessary that we do have more and more NCLT benches across India. So when NCLT started, it was just like a small affair, but now with the growth of corporates and the disputes that are being coming in, and to obviously promote the ease of doing business, it's being said that the NCLT benches should be there across as many states as possible, and we'll discuss all of that as we move forward now. So I think it's more to do with the states, because I think some states may have more case related to the corporate dispute side of things, while the others may have less, so especially the metros and the big cities or the big states actually. So I think accordingly the benches will be created, and they have been created like this way so far. So you see the principal bench is in New Delhi, and then the benches are across various other cities and state that actually gets applicable. Now talking further about it, it says in regard to making an application to the NCLT, so obviously the company do have the powers for sure as we discussed above. But I think apart from that, it's being also written that the application for this compromise and arrangement can also be made by the members and the creditors on behalf of the company. But then there are very less chances that the tribunal will accept it, because of the reason, unless and until the scheme actually gets the prima facie approval by the board of directors of the transferor and the transferee company, it is very difficult that the scheme probably will be accepted and approved and implemented. So tribunal obviously have the powers that they can accept the scheme from the members or the creditors, but more than likely the application will always be moved by the company side. Talking further about the obtaining orders of the tribunal for holding class meetings, I'm sure you're aware that we do have the general meetings, annual general meeting, the extraordinary general meeting, but then we do have the class meeting as well. The class meeting, as the name itself suggests, is a meeting of a particular segment of stakeholders. Like for example, it's only to do with the creditors, so obviously the shareholder will not be called, because shareholders are not the creditors actually. So only and only the creditors like the debenture holders, etc., will be called into the meeting. Or it may be a meeting just consisting of the equity shareholders, so obviously that is also a class. So class means a particular section, a community, or a segment that will be invited, because the company may be doing something that is by and large affecting only that class. So that is why we wanted to know the approval, or we wanted to take the approval for that particular class of people. Because if it is a thing that probably affects everybody across the company right from the start till the end, then it will be preferred and it will be needed actually to call a general meeting. And the name itself says it a general meeting, so it does not really matter what your status is. Be it a creditor or a shareholder, just whatsoever can participate in the meeting. But on the contrary, as I said, we do have class meeting where only particular segments of the company are being called for. The tribunal will definitely look into the orders. I mean, when we discussed earlier, we said that the draft will be filed, the draft application which have been approved by the board of directors will then be filed to the NCLT to have a look, and the NCLT will give it a final go, and then only the meeting of the members of the creditors will be called. So it's being said that the tribunal will look into it, will look into the application, for the reason because tribunal will not like to actually convey the meeting or probably move ahead with these steps of mergers and amalgamation, because I think the entire process is based on the scheme as to how fair and genuinity or how fair or transparent the scheme is. If the tribunal think that the scheme is really not good, or it is illegal or against the provision of law, I think even if the members of the creditors, not just 90%, even if they agree and go for a vote about 100% agree to the same as well, still it cannot be implemented, because I'm sure you must have heard about a thing called as ultra virus. Nobody is above law. So the tribunal will first try and find out the fairness and the legality position, and thereafter we'll move forward in the regard to calling the meeting. The tribunal can give the orders, like they can tribunal can pass the orders to fix the date and time of the meeting, can appoint chairperson, and then can also direct the chairperson to report to the tribunal within so and so many days after the meeting concludes as to the final outcome of the meeting. In regard to the draft notice, so it will be sent to the tribunal, as I said before, it's being really dispatched to everybody across the company. Tribunal will be the first who will receive the draft copy, and if tribunal gives a go ahead, then definitely everybody in the company will get the notice or that explanatory statement. Apart from that, I think we discussed earlier, the notice will also be given individually as needed, but it will also be circulated in the newspapers. It will be an English newspaper and one regional newspaper where the registered office of the company is being situated. You call it as regional, you call it as local, you call it as vernacular, it's mean the same thing. So this is also a requirement that needs to be complied with. In regard to the meeting, so when the meeting is being conveyed, depending upon what happens in the meeting, like if the resolution get passed or even if it doesn't get passed, the chairman will finalize the minutes, like when everybody agrees to it, because obviously the chairman will submit a report to the tribunal saying that how many people in form of the creditors or members attended the meeting, then how many voted in the favor, in the against, and the way the voting was done, like a show of hands or otherwise. So all of that needs to be written in the form of the minutes as well, and the chairman will initiate or initialize the minute, signs the minute, and then a copy of the same along with the other detailed explanation will be sent to the tribunal, so that the tribunal can further decide what course of action needs to be taken. The format in which the reporting needs to be done to the tribunal is being mentioned under the form CAA4. Now I can tell you one thing, that when we are talking about these kind of forms, and I've been showing you these kind of forms, these are not included in ICSI modules, right? These are not there. But just for the purpose that you can understand the context in a very simple and an easy way, and you also get a practical insight to it, I have by my own actually included these kind of forms. You don't really need to learn or write or probably draft any kind of these. It's just for your information that how the form really looks. Because if I say that the the report or the final result has to be submitted to the travel in the form CAA 44, so it's just like CA 44. Nobody knows what CA 44 looks like, right? So if you go for an interview or a job or just anything, if you have these kind of knowledge, probably you have seen the form, you know kind of a context as to what is it all about. I think it will give you a probably a preference as compared to the other candidates, and especially when I've been working as well. I told you earlier, I think at the starting of the class, I'm working as a senior manager compliance in one of the Australian based company. So I think on the practical side of things, I want you to also be updated and make sure that wherever you go, you actually stays up to date with the knowledge. So this is the content of the CAA 4, and in this it's just being said that how many people actually were present at the meeting, and then how many actually voted in the favor, and then how many voted against the resolution, the way the voting was done. I think we discussed this earlier. So all of that will be included, and then the final report will be submitted to the tribunal, and the tribunal will definitely consider that has been whatever has been written, because all of this will be signed by the chairperson only, and the chairperson has been appointed by the tribunal. So according to what report has been given to the tribunal will take the further actions. Then it says the petition to tribunal for confirmation of schemes. So I think we discussed earlier, when the final results are being in front of the chairperson will inform the tribunal, and it's not just that, but the petition will also be required to be made by the transferee company in the form CAA 5, and then the tribunal will look into the results that have been come up from the meeting, and accordingly pass the judgment as needed. Further, it says condition preceded and subsequent to tribunal order sanctioning the scheme. Once the tribunal actually orders like the schemes of the arrangement is being passed by the tribunal, I think every probably copy of the memorandum and the articles of the companies, like the transferee company which is now in existence, will probably have the orders of the tribunal attached to it. Like the copies of the tribunal orders need to be attached to all the MOA and the AOA, and whatever or whosoever asks for the copies of the MOA and AOA needs to be given updated copy which has the order of the tribunal, so that the public knows, or probably the stakeholders know, that this has really been effected and been sanctioned or finally approved by the tribunal. Now, having said all of that, this is the one process, right? This is the process. I'll say this way. For example, you are getting planning to actually getting, like, let's say I'll take an example this way. You wanted to get married, right? So it does not like male, female as the case may be, so whatever your gender is, and your parents did everything, they give a lot of blessings and they did a lot of supports, etc., and finally you got married. Now you got married, you both two got married, and now it's between you two how to take this forward, right? So the company is this way only. The two company actually got merged, and now it is up to the company that how they take it forward, because now the procedural or the statutory requirements have been complied with, but then there will be so many peoples that will or who will come from company A to company B, so many departments, so many cultures, so many human issues. So how do we resolve all of that? That's really another challenge, another side of challenge that we will encounter now, because till this particular point of time we were just concerned, or we were just worried about the approvals of the tribunal, probably the members, the creditors, or the other stakeholder, but that has already been done now and everything is being finalized. Now we have to sort out the internal matters or internal battles as the case may be. So revised organization chart will consist of like how the organization will look like now, like how many departments it will have. Some of the departments may be eliminated, some of the department manpower may be increased or decreased as the case may be. So that organization chart needs to be updated. And as I said just now, that now the phase of change will start. So the people who are, let's say there are two companies A and B, and A company is getting merged to B, right? So the people or the employees of A company will now be the employees of B company. So there are chances that they will be treated as a secondary employee. They may be harassed as well, depending upon the culture that is there in company B. So I think we will have to manage all of that situation, because ultimately, if that is not done, then this company B will suffer. And do not forget that B has already paid probably a substantial amount to acquire the company A. So B has a lot more responsibility now. So it's not just B's responsibility, but the new company that have come up to B, this A company which is being merged to B, all of this responsibility is something that B has to take forward. So we need to make sure that the change or the transition phase has to be smooth as possible. Employee compensation, benefit, welfare activities. So those employees who have come up to this transferee company needs to be given, the rule says, need to be given at least the same designation or the position, but it should not be lower or less than that. But even if you do all of that, then there will be some employees who will not agree, and they will leave the organization, and that's part and parcel of the deal that will happen anyway. And I think I've told you a lot of times, not just for this chapter, but I think for in general speaking as well, that whatever you do, and does not really matter how much efforts you really put in, there will be few people who will be happy with you with whatever little you do, and then there will be few people who will not be happy with you even if you give 1000%. So I think same is the case with the companies and the employees as well. So all of that needs to be taken care of, and the company has to be prepared for that, like at the very start. The accounting and the internal database management system. So there is a company A, there is a company B. So the company A is getting merged to B. So there will be a lot of different policy, process, and internal accounting that B keeps, and probably A was not, company A or company A employees was not doing the same. So all of that needs to be aligned, so that now we can work together as one company. And it is not something that can be done in just one day. It will take probably some weeks, some months, or even maybe a year, depending upon how big the company is, and accordingly we have to take this forward. But as I said, when we are doing all of this, when we are saying all of this should not be something that will come to us as a surprise, right? We have to be aware of this fact, because otherwise this merger, as it's being written in the first line, every merger is not successful, and it will not be successful in case we are just concerned about the NCLT, because now NCLT members, creditors, they are the matter of past. They are being done. Everything is being sorted with them. Now we have to do the business. The entire objective of this restructuring was to make the business better, right? To grow probably money of the investors, to actually give employees a better perks, to increase the profit revenue. So now we have to be more concerned on that. But it should not be something that will start from now. This is something that we should have think about it, or thought about it, when we initially started discussing about this entire exercise. Because anyway, if the tribunal gives the sanction, this was supposed to happen, right? So we need to know that now what is the way forward. We cannot just come to this point and then analyze what needs to be done. We really should have a kind of some idea. I mean, we cannot be 100% sure what needs to be done, but we need to have certain idea that how we are taking this forward. So all of that is a part of parcel that has been written here. So the mergers are not always successful. It says that there are various factors that need to be considered, like the merged company has to obviously generate more returns, probably has to grow the business or the clients in terms of the percentage. The sales, net profit, etc. needs to be increased as compared to the competitors, because now they are not just one company, but they are kind of more than one. I'm not saying two, probably the other company is a weaker company, so I cannot say it is a double. But they are more than one company, right? So now something has to increase. It may take time, that's for sure. So time is the thing that you have to give to anything in life. But I think it's more to do with the fact that we have to see the growth happening. And if it is not there, then probably this merger is not something that we were thinking it to be. Then in regard to the human and cultural aspects, I think I explained this earlier, the employees of the amalgamated entity face secondary treatment sometimes, like the company A employees who are being getting transferred to company B because the company A obviously got dissolved and gets over. So we are saying that there are chances that the company A's employee will be treated as a secondary employee in company B, and there will be some harassment and all those kind of things that usually happen in the form of office politics. So we have to encounter all of that and needs to make sure that the work does not suffer. And obviously there will be some people in this entire process who will leave the company, and even some of the best talent may also leave the company. But as I said, this is something which is part and parcel of this entire deal. You cannot stay always in plus side. There will be days on which you will gain, there will be days in which you will lose. You cannot just lose, you cannot just gain. That's really one of the things that we all have to understand in every aspects of our life, not just the studies perspective but in the life as well. So I think this all has been mentioned in this chapter. And finally, with this we have finally come to the end of I think one of the biggest chapter that we just discussed. And from the next class and onwards, we'll start another chapter that is called as the chapter number 5, the documentation that's being needed to do mergers and amalgamation. So we'll deal and discuss all of that, but that will be something that we'll do from the next class. So thank you so much once again for your time, and I'll see you in the next class. Till then, take care of yourself, and do not forget that with Shantanu and Tanya Academy, you get the widest ICSI module coverage classes. And it's not just the classes in complete English. I do have all the subjects of CS Professional available in Hindi, like Hindi English normal combination. Then we do have all the fast track in complete Hindi, like again Hindi English normal combination. And then we do have all the fast track which are in complete English. I think CRIV is the last subject that I'm doing. Apart from that, we do have every other subjects that's being available in English, be it drafting, GMRC, secretarial audit, RCD, corporate funding. So I think and MDCS as well. So you can definitely look to those as well. Thank you so much once again for choosing Shantanu and Tanya Academy.